The economics of owning a landfill. Imagine owning a business where every customer pays you to permanently use up part of your most valuable asset. A truck rolls onto the scale. Its load is weighed. The landfill earns a disposal fee. Then that truck drives to the working face, unloads, and the material is compacted into the site. The transaction looks simple. Waste comes in, money comes in. But from the owner's side, something else just happened. A small piece of the landfill's permitted capacity disappeared forever. That is the unusual economics of this business. A modern municipal solid waste landfill is not just a piece of land with a gate and some heavy equipment. It is an engineered, regulated disposal asset. Its most important inventory is permitted airspace. And unlike a warehouse, a factory, or a hotel, selling more of that inventory today can bring the end of the asset closer. So the central question is not simply how much can you charge per ton. It is how much can you earn from each ton while paying to build the next cell, operate the environmental systems, secure the next permit, and fund obligations that may continue for years after the last paying truck has left. If you were evaluating a landfill as a potential owner, the first mistake would be to value it like ordinary land. The dirt matters, the location matters, the acreage matters. But the business does not get paid because it owns acres. It gets paid because regulators have allowed a defined amount of engineered disposal capacity to exist on those acres. That is why large operators think in terms of remaining permitted airspace and remaining site life. Waste Management, for example, reported 253 solid waste landfills at the end of 2025. Across its solid waste landfills, it received roughly 127.7 million depletable tons during the year. The company also reported a weighted average remaining permitted landfill life of roughly 38 years based on projected disposal volumes. If qualifying expansion airspace was included, that figure rose to roughly 39 years. Those are company-level figures, not an industry average. A specific landfill can look very different, but they reveal how the asset is managed. Remaining life is not some abstract environmental statistic. It is a business variable. Republic Services gives another view of scale. At the end of 2025, it reported 207 active landfills. Its active solid waste landfill footprint covered a very large acreage, but only part of that acreage was permitted. That distinction is crucial. Owning land next to a landfill does not automatically mean you own future disposal capacity. Permitted capacity is created through engineering, regulation, and approvals. Until those pieces are in place, extra land is only potential. This changes how you should think about the inventory. In a retailer, selling one more unit creates a need to restock. In a software company, serving one more customer does not permanently consume the code. In a landfill, taking one more ton converts a fraction of finite permitted space into revenue, and that exact space cannot be sold again. The accounting used by major operators reflects this physical reality. Waste Management and Republic Services both use units of consumption approaches that tie significant landfill development and closure-related costs to the airspace being consumed. For an owner, this turns remaining life into something close to a strategic clock. A site with a long permitted runway gives management more time to sequence cell development, pursue future approvals, and decide how aggressively to fill the network around it. A site with a short runway can still be valuable, but the next decisions arrive sooner. Capital has to be committed sooner. Permit uncertainty matters sooner. Closure planning becomes more immediate. So, two landfills accepting similar waste can have very different economics even before you ask what customers pay. One may have decades of permitted life and a clear expansion path. Another may be operating against a hard capacity ceiling. That is the first major owner lesson. Acreage describes the property, but permitted life describes the business runway. And once you see the asset that way, the next question becomes unavoidable. How much capital does it take to turn potential land into the next block of usable capacity? From the road, a landfill can look deceptively simple. There are trucks, earth-moving equipment, slopes, dirt, and waste being covered. From the owner's capital budget, it looks very different. A modern landfill is developed in engineered sections or cells. Before a cell can become revenue-producing capacity, the owner may have to pay for land and permitting, excavation, liner systems, leachate collection, landfill-gas collection and monitoring infrastructure, groundwater monitoring wells, engineering work, roads, and other environmental systems. This is why a headline claiming that a landfill costs X dollars to build is usually not very useful. The actual cost can depend on the site, geology, engineering requirements, local rules, the design of environmental systems, land conditions, and the scale of development. The better way to understand the capital intensity is to look at what large operators spend across their networks. Waste Management added about $832 million to the cost basis of landfill assets during 2025. It also estimated approximately $874 million of landfill construction and development spending in 2026, with about $1.8 billion combined in 2027 and 2028. Those numbers are not the cost of a single new landfill. They are company-wide spending figures. But that is exactly why they are useful. They show that landfill ownership is not a business where you acquire land, buy a bulldozer, and then simply collect gate fees for decades. Capacity itself has to be continuously developed. Think about the timing problem from an owner's seat. You cannot wait until the current working area has effectively run out and then decide to build the next cell. Development spending has to happen before the existing operational capacity is exhausted. Engineering and permitting have to precede construction. Construction has to precede the revenue that new capacity can support. That creates a capital cycle inside a much longer asset life. A landfill may have decades of total permitted runway, yet still require recurring waves of development spending as operations progress across the site. In other words, 30 years of remaining life does not mean 30 years without major capital decisions. This matters when evaluating cash flow. A simple model might treat a landfill as a mature asset with low incremental needs once it is open. The development disclosures from large operators show why that can be misleading. The owner is continuously converting permitted potential into developed capacity. And much of that spending does not produce a flashy new customer-facing feature. A liner system is not a revenue feature. A groundwater monitoring well does not raise the brand value of the landfill. A leachate collection system does not make the gate fee more exciting. But those systems are part of what makes the disposal capacity usable. This also creates a distinction between three layers of value. First, there is the land itself. Second, there is permitted airspace, the regulatory right to use a defined capacity for disposal. Third, there is developed capacity that is actually ready to receive waste through the operating sequence. A buyer who collapses those three layers into one number can misunderstand both the value and the future capital requirements of the site. The same logic explains why there is no responsible universal startup cost for a landfill. One site may require very different engineering, excavation, monitoring, and environmental systems from another. The approved research supports the cost stack, but not a single national build number. For a potential owner, the useful question is therefore not, what does a landfill cost? It is, what capital has already been spent? What permitted capacity exists? What development work remains? And when will the next tranche of spending be required? After that cell opens, the owner finally gets paid for using it. But the economics of that payment cannot be understood from the gate fee alone. Suppose one more truck arrives. The scale records the load. The customer pays according to the relevant disposal arrangement. The landfill gets revenue. What costs did that truck create? Some costs are immediate operating costs. Active landfills have to manage things like daily cover, leachate treatment and disposal, methane gas systems, groundwater monitoring, interim cap maintenance, and ongoing environmental compliance. Other costs are tied to the fact that the load occupies capacity that can never be sold again. Waste management provides a useful accounting illustration. In 2025, the company reported about $898 million of landfill airspace depletion expense on roughly 129 million tons received, or an average of $6.96 per ton. That figure requires careful handling. It is not a national industry cost per ton. It is not waste management's total cash operating cost per ton. And it is not the price a customer paid at the gate. It is an accounting measure connected to the consumption of landfill airspace, and the company explicitly says per-ton depletion rates vary significantly from one landfill to another. But as an owner-level concept, it is extremely revealing because it separates a landfill from an ordinary throughput business. If a factory runs another unit through a production line, the factory still exists with essentially the same floor space. If a warehouse ships another pallet, the rack can be refilled. A landfill's usable capacity moves in only one direction unless additional airspace is permitted and developed. That means the economics of volume depend on what the owner is giving up in exchange for today's revenue. Higher volume can increase near-term disposal revenue. It may improve utilization of existing operating systems. If the owner also controls collection routes or transfer stations, internalized volume can strengthen the economics of the wider network. But higher volume can also shorten the time before the next major capital event. Imagine two operating choices at the same landfill. One brings more tons through the gate now. The other preserves more remaining life. Without a verified site-specific price and cost structure, we cannot declare which choice is better. But we can say what the owner must compare: current contribution versus the value of the capacity consumed and the timing of future development and closure spending. This is why the price of a ton cannot be judged only against the visible cost of receiving and compacting it. The life cycle view includes today's operating systems, future cell development, future capping, and the eventual post-closure tail. Waste management's disclosures also show the scale of ongoing environmental categories. In its 2025 landfill and environmental note, it reported $549 million across listed landfill operating cost categories, including $235 million for leachate and methane collection and treatment. Again, that is not the total cost of operating every waste management landfill. It is a set of specific categories disclosed by the company. But it reinforces the point that the economic engine at the gate sits on top of a large environmental operating system. For a buyer or operator, this creates a more disciplined version of unit economics. You want to know what a ton contributes after the costs that move with active operations. You want to understand how the site's accounting depletion reflects the capitalized cost of capacity. You want to know how quickly the current volume profile advances the development calendar, and you want to know whether that volume is strategically valuable because it comes from your own collection network or economically fragile because third-party haulers have attractive alternatives. The approved research does not give us one universal tipping fee or one universal margin, and that is a feature, not a weakness. It forces the analysis toward the variables that actually differ from site to site. The first of those variables is geography. Waste is heavy. The landfill is fixed. And a disposal site that looks powerful on a spreadsheet can become much less attractive if the transportation network works against it. A landfill is physically fixed. Its customers are not. Waste can move, but moving it farther requires trucks, drivers, fuel, equipment, time, and transfer infrastructure. That makes geography central to the value of the disposal asset. One way large waste companies manage that geography is through transfer stations. A collection truck is designed to pick up waste across a route. It is not necessarily the most efficient vehicle for a long trip to a distant landfill. A transfer station allows waste from multiple collection vehicles to be consolidated into larger transfer vehicles. Republic Services describes transfer stations as a way to reduce transportation costs and extend the geographic reach of landfills. From the landfill owner's perspective, a transfer station can enlarge the practical market around the site. A landfill that is too far for dozens of local collection trucks may still be economical if those trucks unload at a closer transfer station and a larger vehicle carries consolidated waste the rest of the way. That means the market boundary of a landfill is not drawn only by miles. It is drawn by the network that can move tons economically. For a standalone landfill that can create dependence on third-party hauling decisions. A hauler compares disposal alternatives through its own route and transportation economics. A site can have plenty of capacity and still lose volume if the network makes another outlet more attractive. For an integrated operator, the calculation can be different. Republic reported that approximately 67% of the solid waste volume it collected in 2025 was disposed at landfills it owned or operated. The company says its fully integrated markets generally have lower operating costs and more favorable cash flows than non-integrated markets. That does not mean integration guarantees superior economics everywhere. It means the value of the landfill can extend beyond the revenue collected at its own gate. If a company controls collection, transfer, and disposal, it can evaluate the economics of the whole chain. The transfer station may reduce long-haul inefficiency. The landfill may provide a dependable destination for internal collection volume. The collection operation may supply volume that supports the disposal asset. The important owner question becomes, where is the profit pool really created? At collection, at transfer, at disposal, or through the combination? The public disclosures do not give us one universal answer, but they show why a landfill should not always be valued as an isolated property. This is also where people sometimes jump too quickly to the word monopoly. Landfills can benefit from scarcity. Permitting is difficult. Hauling distance matters. Nearby disposal alternatives may be limited. But saying every landfill is a local monopoly would be wrong. Large operators themselves describe competitive markets, and public or municipal disposal alternatives can exist. The strength of a site's position depends on the actual local network, competing capacity, transportation economics, contracts, transfer options, and the remaining life of each facility. So, the moat of a landfill, when one exists, may be a combination of permitted capacity and network position rather than a simple absence of competitors. For a potential owner, this makes due diligence very physical. You would want to understand not just the permitted map of the landfill, but the route map around it. Where are the transfer stations? Which volumes can economically reach the site? Which volumes are controlled internally? What competing disposal capacity is practical for those same customers? The landfill can be an unusually durable node inside the right network, but no network can solve one constraint forever. Eventually, the owner needs more capacity. And creating that next block of inventory requires something a balance sheet alone cannot guarantee: permission. Imagine a landfill with strong demand and a successful operating history. The owner sees years of incoming volume ahead. There is adjacent land. Engineers believe more capacity may be technically possible. Does that mean the business has more inventory? Not yet. Expansion is a regulatory and political process as much as an engineering project. Large operators evaluate things such as local approvals, state permits, technical feasibility, legal constraints, community and political impediments, economics, and the probability of receiving approval before treating potential expansion airspace as probable. That tells you something important about the value of a landfill. The useful asset is not theoretical capacity. The useful asset is capacity the owner has a credible path to permit and develop. Waste Management's 2025 disclosures show that this is an ongoing part of running a large landfill portfolio. At year-end, the company said it was seeking expansion permits at 15 landfills that met its accounting criteria. During 2025, it reported receiving expansion permits at 13 landfills. Those figures should not be read as a universal approval rate. They simply show that even a mature operator with hundreds of sites continuously works on the next layer of capacity. This creates a planning problem that can begin years before current capacity is exhausted. If management waits too long to pursue an expansion, a permitting delay can become a business capacity problem. If management assumes expansion will arrive and it does not, the site can reach its effective ceiling with a network still built around sending waste there. On the other hand, spending heavily to prepare for an expansion that never receives approval can also destroy value. That is why permit probability enters the economics rather than sitting in a separate legal appendix. This is also why remaining life figures deserve more attention than they usually get. Waste Management's weighted average remaining permitted life of about 38 years sounds long. But that is a portfolio average based on projected disposal volume. Individual sites can have very different runways. And even at a long-life landfill, new cells still have to be developed over time. For the owner, remaining life interacts with volume strategy. If an expansion appears credible, the owner may be more comfortable accepting attractive incremental volume because the development runway can potentially be extended. If expansion faces major uncertainty, the current permitted capacity may need to be managed more defensively. The strategic value of preserving site life increases because there may be no replacement inventory behind it. That does not tell us the correct gate price. We do not have a universal price. It tells us what the owner should be pricing against, not just today's operating cost, but scarcity and replacement risk. There is a second-order effect inside an integrated network. If a company's collection and transfer system depends heavily on one landfill, a failed expansion does not only affect the landfill. It can force the broader network to find another disposal path. That can change transportation distances and reduce the advantage of internalization. So, an expansion permit can have strategic value beyond the new airspace itself. This is why growth is not just a sales problem. It is a permission problem, a timing problem, and sometimes a network problem. And while management works on tomorrow's capacity, today's landfill still has to operate as a tightly controlled environmental system. The old mental image of a landfill is a place where waste is dumped and buried. That is not a useful model for understanding a modern, regulated municipal solid waste landfill. From the owner's perspective, the operating site is a collection of systems that have to keep working while waste moves through the asset over time. Leachate has to be collected and managed. Methane gas systems have to operate and be monitored where applicable. Groundwater monitoring continues. Daily cover and interim cap work has to be performed. Environmental rules create recurring compliance tasks. These are not costs that appear only when something goes wrong. They are part of ordinary operation. Republic Services specifically identifies active life landfill expenses such as leachate treatment and disposal, methane gas and groundwater monitoring and maintenance, interim cap maintenance, daily cover, and environmental compliance. That means the working face, the visible place where trucks unload, is only one small piece of the operating business. Below and around it are systems designed to control liquids and gases. Around the property are monitoring points. Across the site, the operator has to coordinate earthwork, cover, access, equipment, and environmental obligations while preserving usable capacity. For an owner, the important distinction is between a cost that buys future capacity and a cost that keeps existing capacity operable. Cell development and related construction create the next usable portion of the asset. Leachate handling, monitoring, daily cover, and environmental maintenance keep the operating asset functioning within its obligations. Both matter, but they hit the economics differently. One is tied more closely to development timing. The other continues as part of the active life operating burden. This is why looking only at revenue per ton can hide the operating structure. A landfill can have strong demand and still require substantial spending simply to maintain the systems surrounding that demand. Waste Management's disclosed landfill operating categories reinforce that point. The company reported hundreds of millions of dollars across the specific environmental and landfill cost categories listed in its 2025 note, including leachate and methane collection and treatment. That is not the company's total landfill cost base, but it demonstrates that these systems are economically material at scale. Operational quality also matters because the landfill has to protect the runway created by permits and capital spending. An owner does not want capacity merely to exist on paper. It has to remain usable through the actual operating sequence. The site needs functioning environmental infrastructure as waste is placed, as interim areas are managed, and as completed areas move toward capping. Landfill gas is a good example of how operations and regulation overlap. Methane-rich gas is not merely a potential product. EPA maintains federal standards and guidelines aimed at reducing landfill gas emissions from municipal solid waste landfills. So gas collection and control can be part of the compliance architecture. That matters because a system installed or operated for environmental reasons may also create an opportunity to monetize the gas. But the owner should be careful not to reverse the logic. The landfill is not automatically an energy project that happens to accept waste. Disposal is still the core asset. Gas economics depend on the characteristics of the site, and the best structure may not involve the landfill owner building the energy project at all. That distinction becomes clearer when we look at how landfill gas projects are actually structured. Organic material buried in a landfill can generate landfill gas over time, including methane. If the site captures that gas, there are several potential uses. EPA identifies operating projects that use landfill gas for electricity generation, direct thermal applications, and upgrading to pipeline-quality gas, among other uses. That makes for an appealing business story. Customers pay you to bring material in, then the buried material creates a second energy product later. But that version is too neat. Landfill gas output varies by site. EPA's LandGIM model illustrates some of the variables that influence emissions, including design capacity, the amount of waste already in place, annual waste acceptance, methane generation assumptions, and years of operation. In other words, two landfills should not be assumed to produce the same gas stream or support the same project economics. EPA's Landfill Methane Outreach Program database gives a sense of how established the concept is. Using September 2024 data, EPA reported that 488 municipal solid waste landfills supplied gas to 542 operating landfill gas energy projects. EPA also identified hundreds of additional candidate landfills, while cautioning that the database is not a complete inventory of all U.S. municipal solid waste landfills. So the opportunity is real, but it is not universal. And ownership structure matters. Republic Services reported 77 landfill gas-to-energy projects at its landfills at the end of 2025. The interesting detail is that the majority were developed, owned, and operated by third parties. Republic supplied the landfill gas and earned a royalty. That is a useful owner lesson. If a landfill produces a monetizable gas stream, the owner does not necessarily have to become an energy developer. Depending on the project, it may make more sense to partner with a third party that takes on development and operating responsibilities while the landfill earns from supplying the gas. From a capital allocation perspective, that can change the character of the opportunity. The question is no longer simply, can this landfill produce energy? It becomes, who should own the conversion equipment? Who should take project risk? And what role should the landfill owner play? The approved research does not give one universal answer. Republic's disclosed royalty structure proves only that third-party ownership is a meaningful model in practice. This is exactly why landfill gas should be treated as an optional layer rather than the foundation of the investment thesis. A site with useful gas characteristics may gain additional economics. A site with weaker characteristics may not. Either way, the landfill still has to satisfy its environmental obligations around gas control where applicable, and the disposal business still carries a much longer financial story than the operating gate suggests. Because even an excellent gas project does not erase the cost of closing and monitoring the landfill after disposal ends. Picture the final day of an operating landfill. The last load arrives. The scale records it. The final paying truck leaves. If this were a factory, you might sell the machinery, close the building, and wind down the remaining obligations. A landfill is different. Federal rules require closure activities that include installing a final cover designed to limit infiltration and erosion. Closure planning and certification are regulated processes. Then comes post-closure care. Under the Federal Municipal Solid Waste Landfill Framework, post-closure care generally has a 30-year baseline. But that period is not an absolute fixed timer for every site. An approved state program director can shorten or extend the period depending on site conditions and what is needed to protect health and the environment. During post-closure, the landfill may still require maintenance and monitoring of the final cover, the leachate collection system, groundwater monitoring, and methane gas monitoring systems. Think about the cash flow shape from the owner's perspective. During the active life, trucks arrive and generate disposal revenue while the company pays operating costs and invests in development. After closure, the truck revenue can disappear, but environmental responsibilities remain. That is why financial assurance is built into the regulatory structure. Private municipal solid waste landfill owners and operators generally have to demonstrate financial assurance for required closure, post-closure care, and corrective action. EPA explains that closure and post-closure cost estimates are prepared before operations and adjusted for inflation during the active life. The basic principle is straightforward. The ability to meet future environmental obligations should not depend entirely on whether the landfill happens to be profitable decades later. For an owner, this changes the meaning of today's earnings. A landfill may generate cash during its active years, but part of the economic burden belongs to a future period when the disposal operation is no longer producing the same gate revenue. If that future burden is ignored when judging current economics, the active period can look better than the full life cycle really is. That is why closure is not just an environmental ending. It is part of the unit economics of the asset over time. Large company balance sheets show how substantial these future obligations can become across a portfolio. At the end of 2025, Waste Management reported roughly $3.3 billion of landfill asset retirement obligations related to final capping, closure, and post-closure. Republic Services reported approximately $2.313 billion of accrued final capping, closure, and post-closure costs at the end of 2025. Those numbers need an important caveat. They are accounting liabilities across large portfolios. They are not the amount each company will write as a single cash check in 1 year. They also should not be used to estimate the liability of a small independent landfill. But they reveal the scale of the long tail. The landfill owner is not simply monetizing a pile of waste. The owner is managing a life cycle obligation. This makes the development calendar and the closure calendar mirror images of each other. Early in the asset life, capital is spent to create usable cells before the corresponding disposal revenue arrives. Late in the asset life, money must still support capping, monitoring, and post-closure systems after the corresponding disposal revenue has ended. The attractive middle, the active operating years, is therefore bracketed by capital requirements on both sides. That is a much more demanding framework than charge a fee to bury trash. It also changes the meaning of remaining life. A long runway is valuable not merely because it means more years of revenue. It gives management more time to sequence development and spread the transition toward eventual closure. A short runway makes the end state more immediate. If expansion is uncertain, the owner has fewer opportunities to defer or reshape that transition. Now return to the decision to pursue more volume. More tons can improve near-term revenue, but they can also advance the timeline for the next cell and the next permit. Eventually, they advance the point when the active disposal phase ends. This does not make volume bad. It means volume should be evaluated against the entire life cycle, not just today's working phase.
A ton accepted near the beginning of a long-lived site and a ton accepted at a capacity-constrained site may create very different strategic consequences, even if the operational act of receiving them looks the same.
So by the time the last truck leaves, many of the most important financial decisions were made years earlier. How the site valued its remaining runway, how it sequenced capital, how it approached expansion, and how it funded the obligations that would survive closure. Now we can evaluate the landfill the way a potential owner would. Start with the obvious attraction. You control a permitted disposal asset in a business where usable capacity cannot simply be replicated on demand. If the location works, if the surrounding network can deliver waste economically, and if the site has substantial permitted life, the landfill can behave like durable infrastructure. But every one of those conditions has a second side. A strong location can create demand, but demand advances the development schedule. Vertical integration can bring internal volume and improve network economics, but it also ties the collection and transfer system more closely to the long-term availability of disposal capacity. A transfer station can extend the site's reach, but it does not solve a future capacity shortage. An expansion can add years of life, but an expansion is not automatic. It depends on engineering, permits, approvals, economics, and community and political realities. Landfill gas can create additional value, but site economics vary, and the owner may earn through a third-party arrangement rather than owning the energy project. And eventually, closure costs arrive even after the disposal gate stops producing revenue. This is why there is no single number that tells you whether a landfill is a good business. A national average tipping fee would not be enough. A generic construction cost estimate would not be enough. Even a headline operating margin from a large waste company would not tell you what a particular site is worth. A serious owner would need to build the answer from the site outward. First, what is the remaining permitted runway under the expected volume profile? Second, what portion of that runway is already developed, and what capital will be needed to bring future cells online? Third, how reliable is the waste network feeding the site? Is the volume controlled through owned collection and transfer assets, or does it depend more heavily on third-party decisions? Fourth, what practical disposal alternatives exist in the local market, and how does the transport network shape competition? Fifth, what expansion path is technically and politically plausible, and how much of the long-term valuation depends on permits that do not yet exist? Sixth, what active life environmental systems have to be funded and maintained? And seventh, what closure and post-closure obligations remain after the revenue phase winds down? Those questions are more useful than a generic profit claim because they expose where the value can break. A landfill with strong demand but little remaining capacity may be very different from one with a long runway. A landfill with potential expansion but severe approval uncertainty may be very different from one with already permitted space. A landfill inside an integrated collection transfer network may be more strategically important than a standalone site with the same physical capacity. And a site that looks inexpensive on today's operating numbers may be less attractive once future development and closure obligations are included. That is the deeper lesson from Republic's internalization data. When the same company controls collection, transfer, and disposal, the landfill can be part of a system rather than a standalone destination. The value of the site is partly the value it creates across that network. The durable version of this business therefore comes from alignment. The permitted runway has to match the volume strategy. The development calendar has to match the pace of capacity use. The transport network has to make the site economically reachable. The permit strategy has to begin before capacity becomes an emergency. And the economics of the active years have to support obligations that outlive the active years. That is what makes landfill ownership so different from the simple image people have of the business. You are not buying empty land and charging people to fill it. You are buying the right and the obligation to manage a highly regulated piece of capacity over an unusually long life cycle. The engineered cell has to be built before the revenue arrives. The environmental systems have to operate while the revenue is arriving. The next permit has to be pursued before the existing runway is gone. And the final cover, monitoring, and post-closure responsibilities remain after the revenue from disposal has ended. So, return one last time to that truck crossing the scale. To the customer, it is a load that needs to disappear. To the landfill operator, it is revenue. To the owner, it is a decision about the full life of the asset. Today's contribution, tomorrow's development schedule, the reliability of the surrounding network, the probability of future permits, and the obligations waiting at the end. That is the economics of owning a landfill. The durable asset is not the dirt. It is the ability to manage scarce permitted capacity as infrastructure, develop it at the right time, operate it within its environmental obligations, connect it to an efficient network, and fund the responsibilities that remain after the last truck leaves.